Hello everyone, welcome to a short lesson video on IAS-7 Cash Flow Statement for A-Level Accounting. We will solve a tricky past paper question that will combine both IAS-7 and IAS-16 Property, Plant and Equipment. This sum is taken from Feb-March 2019, paper 3-2. We have been given the statement of cash flows for TPLC for the year ended December 31, 2018. Some additional information has been provided to us, and then we have been asked to prepare the non-current asset schedule, which is as per IAS-16 Property, Plant and Equipment for the year ended 31st December 2018. And we are also required to prepare the statement of changes in equity. So let's jump right into it. You can see that there are three non-current assets: land and buildings, machinery, and fixtures and fittings. Keeping this in mind, we can now prepare the non-current asset schedule format. Let's label our table. Schedule of non-current assets. Please note that abbreviations are not allowed in the Cambridge exams. We have three assets, non-current assets: land and building, machinery, fixtures and fair, a total column because the sum asks for it. All figures are in thousands of dollars. So I always prefer to prepare the format of the schedule of non-current assets first and then fill in the figures. So we will start with the cost of non-current assets at the beginning of the year, that is 1st Jan 2018. Then we show the cost of the purchases which were made during the year, purchases of non-current assets. Then we will show the cost of non-current assets disposed during the year. And finally, we will arrive at the cost of non-current assets held on the last day of the year, that is in this case 31st December 2018. So this takes care of the cost. We will then look at the depreciation. So we will show accumulated depreciation on the first day of the year. The depreciation charged for the year comes next. Depreciation on non-current assets which were sold during the year will come next. That is eliminated depreciation on disposed assets, that is disposals. And the last thing is accumulated depreciation on the last day of the year. So we have taken care of the cost, then we took care of the depreciation. So when we subtract depreciation from our cost, what do we get? The net book value. So we will show net book value on the last day of the year. And lastly, we have the net book value on the first day of the year. Coming back to the question. The question states balances at 1st Jan 2018 were land and building cost and accumulated depreciation, machinery cost and accumulated depreciation, and fixtures and fittings cost and accumulated depreciation. So these are your opening balances of cost and accumulated depreciation. So we will write them down in our schedule. So for land and building, it is 400,000. Machinery, it is 214,000. Fixtures and fittings, it is 82,000, a total of 696,000. And the accumulated depreciation opening is 12,000, 112,000, 17,000, that is 141,000. Let us now look at the cost of purchases and disposals that we have made during the year. So the question says, the cost of the non-current assets purchased was 262,000 for machinery and 10,000 for fixtures and fittings. And the third point says the machinery sold during the year had an original cost of $100,000. We will enter this information in the schedule now. So land and building has not been purchased during the year. $262,000 worth of machinery has been purchased. $10,000 worth of fixtures and fittings have been purchased. So a total of $272,000. During the year, there have been no disposals of land and building, but machinery, the cost of which was $100,000, has been disposed. No disposal of fixtures and fittings. So $100,000 in the total column. So now we can arrive at the cost of non-current assets held on 31st December 2018. Let's total each column one by one. 400, 376, 92, and a total cost of $868,000. Please note that the figures in brackets mean that those figures have to be subtracted because the non-current assets are being disposed and are leaving the business. We must now fill in the row for depreciation charged during the year. In the cash flow statement, the depreciation charged during the year is added back to the profit from operations, and we can easily pick up these figures from here for land and building, machinery, and fixtures and fittings. So we can now write the depreciation charged for the year in the schedule. A total of $97,000. We must now find out the depreciation on assets which were disposed during the year. That is the eliminated depreciation, for which we will prepare working note 1. Only machinery has been sold during the year. No other non-current asset has been sold. Machinery has been sold for $42,000. That means the selling price of machinery is $42,000. There is a profit on disposal of machinery of $12,000. So we will write profit on disposal, that is $12,000. So machinery that has been sold for $42,000 has made a profit on sale of $12,000. Therefore, the net book value of the machine must have been sale price minus profit, that is $30,000. We also know that the machinery which was sold during the year had a cost of $100,000. So the original cost of this machine was $100,000, and when it was sold, the net book value was $30,000. Therefore, the depreciation on that machine was cost minus net book value, that is $70,000. Now, due to space constraints, I have shown this working here, but in the exam, you will be required to show this working as part of your working notes. So there was no disposal of land and building, but there was disposal of machinery, and the depreciation on machinery that had been disposed, accumulated depreciation we just computed, was $70,000. No disposal of furniture and fittings. So a total of $70,000. Again, this figure is in brackets because it relates to an asset which was disposed. It has gone out of the business, so it will be subtracted. We may now compute accumulated depreciation on the last day of the year. So the total accumulated depreciation on the last day of the year on all non-current assets is $168,000. We know the cost on the last day of the year, accumulated depreciation on the last day of the year. We can find out the net book value on the last day of the year, that is cost minus accumulated depreciation on the last day of the year, which is $384,000 for land and building. Same way, we will subtract $126,000 from $376,000 to arrive at the net book value of plant and machinery on the last day of the year, $250,000. For fixtures and fittings, $66,000, and the total is $700,000. We know the cost on the first day of the year, the accumulated depreciation on the first day of the year, so we can find out the net book value on the first day of the year, that is cost minus accumulated depreciation, a total of $555,000 on the first day of the year. So that is the schedule of non-current assets as per IAS 16. We will now prepare the statement of changes in equity, part B of the question. Let us see which columns are required for the format. Ordinary share capital, retained earnings, and general reserve are given to us in the question. We are also given in point 4 that there was a rights issue made at a premium of $0.2 per share. So we will also need a share premium column. Let's label our table. Statement of changes in equity for the year ended 31st December 2018. The first column is details, the second column is share capital, third one is share premium, then retained earnings, general reserve, and the total column is required. Figures are in thousands of dollars. Statement of changes in equity always starts with the opening balances. Balance at 1st Jan 2018. 500,000 for share capital. There is no balance for share premium at the beginning of the year. 105,000 for retained earnings and 40,000 for general reserve, which gives us a total of 645,000 at the beginning of the year. After the opening balances, I would strongly recommend that you write the profit for the year next. For this, we will have to prepare working note 2. In the question, we are given the profit from operations. We have not been given the profit for the year. We'll have to find that out from profit from operations. So we will prepare working note 2. We know that profit for the year is equal to profit from operations minus interest charged in the year minus tax charged for the year. We know that profit from operations is 288,000. Let us find out the interest and tax charged for the year. So like I said, the profit from operations for the year is $288,000. Then they have told us that the tax owing amounted to $72,000 at the start of the year and $85,000 at the end of the year. They have also told us that the tax paid during the year is $87,000. We will have to now prepare the provision for taxation account to find out the tax charged during the year. So this is the provision for taxation account. The tax owing at the beginning of the year was $72,000. So that is a liability. It will have a credit balance. Balance brought down 72. At the end of the year, the tax owing was $85,000. So that is our balance carried down $85,000. All liabilities have credit balances. During the year, the tax paid was $87,000. So bank 87,000. We will now balance this account, $172,000 on each side. We are left with a balancing figure of $100,000, which is nothing but the taxation that has been charged to the income statement during the year. This is our tax expense for the year. So in our working note 2, we will write down minus 100 for tax charge. Let us now find out the interest charged. So interest payable at the beginning of the year was $10,000. Interest payable at the end of the year was $2,000. And interest paid during the year is $29,000. We now have to find out the interest charged for the year, the interest expense for the year. We will have to prepare an interest payable account for that. So our interest payable account will look pretty similar to our provision for taxation account. The amount which is due at the beginning of the year will be a liability, will have a credit balance. Balance brought down is 10,000. The closing balance at the end of the year, it is $2,000. Then during the year, we have paid interest of $29,000. We saw that in the cash flow statement. We will now total each side. So the interest charged to the income statement during the year is $21,000. So our interest charged during the year is $21,000, and that brings our profit for the year to $167,000. So we can now enter this figure in our schedule. Always profit for the year will be added to retained earnings, $167,000, and also in the total. Once you have entered the opening balances and the profit for the year in the statement of changes in equity, you must focus next on cash flows from financing activities. So we have been told that proceeds from rights issue of shares is $480,000. But we have also been told that the rights issue was made at a premium of $0.2 per share. We have also been told that the face value or nominal value of shares in this company is $1. Bearing these things in mind, we will now find out how much increase in the share capital and the share premium has been made during the year. Let the number of rights issue shares be X. Therefore, the face value of rights shares is equal to $1 into X. $1 because that is the face value of each share in this company. So the total face value of the rights shares is $X. And the share premium of rights shares is $0.2 per share. So it will be 0.2 into X, that is 0.2x dollars. The company has received $480,000 from the rights issue of shares. Therefore, X plus 0.2x face value plus share premium on rights shares is equal to $480,000. That is the total proceeds from the issue of rights shares. Solving the equation, X is equal to 400. Therefore, the face value of rights shares is 400 into $1, that is $400,000, and the share premium on rights shares is 400 into $0.2, that is $80,000. So we can now record this in our schedule, that is issue of rights shares, which was working note 3. So there was an increase of 400,000 in the share capital and an increase of $80,000 in the share premium. That is a total increase of $480,000. We will now look at the second item in the financing activities, that is the dividends paid. So dividends paid $80,000. Dividends are paid out of retained earnings always, unless of course retained earnings are not there, in which case then they will be paid out of general reserve. So $80,000 of dividends. It is a negative figure because there is a decrease in the equity. The third item in the cash flows from financing activities, repayment of debentures, will not affect our statement of changes in equity because this is not owner's capital. rather lender's capital. So it is not equity. We can now look at point number 7 in the additional information. A transfer to general reserve $10,000 has been made by the directors. So the transfer to general reserve will be made from the retained earnings. $10,000 gone from the retained earnings and $10,000 will be added to general reserve. So there is no change in the total column. We can now find out the balance on the last day of the year, that is 31st December 2018. Just total all the columns. So $980,000, $182,000, $50,000, and $1,212,000. So that was a tricky past paper question on cash flow statements. We will start a new topic in the next lecture.